Well, believe it or not, this is a welcome relief to what's been going on. Consider the Dow's been up 23% since July. We're looking at 8 straight weeks of up markets in the S&P. The market's been so perplexed with macro issues, and right now it seems to be singularly focused on micro issues, and that's U.S. earnings. Some of this might be technical based, where the S&Ps right now are sitting at a 10-day moving average of 1280. That was a level that was so hard to get past in December and early January, and now we're looking at it as a resistance point. So it seems like this market going down today, we're at 14 points down in the S&P. It's very controlled. It's very quiet, as you can hear behind me. It needed to happen.
How do you feel the earnings season is being received so far?
That's funny. You look at the big cap stocks, you know, the JP Morgan, the Apple, Goldman Sachs. By and large, they had great earnings. Some of them even exceeded the best expectations. And even with that, it seems like the market built that in to the price of the stock already. And that happens quite often, where you buy the rumor and sell the news. And this is a classic example. Look what happened to Apple last night, with exceeding expectations by 70-something%. And still the stock is down right now as we speak, going into the closing bell in Chicago. And that goes to show you that you do buy the rumor and sometimes you do sell the fact.
Hi, Larry. John Noonan from Thomson Reuters. I think the market was certainly due for a correction. Now, in your view, how long will this correction, in percentage terms, for the S&P, for instance? Do you see this correction having a little bit of legs? Can we get down to, say, support about 1,250? Can we go that far, or is this going to be a very shallow, very quick correction upward again?
It seems like it's going to be a really shallow correction. The next level we're looking at is like 1260 in the S&P. That would be 20 points lower from where we are right now. All that to say, if some of these macro issues start to come back into the market, sovereign debt crisis, our U.S. municipal crisis that is pending, runaway oil prices, if any of those things seem to peek their head into the market, I mean, 1260 will be long gone. Will be much lower than that. But right now, it seems like the macro issues are almost better. Look at China. Their CPI number, people are starting to revise that lower. And the credit default swap spreads in Europe seem to be tightening, showing that there's less of a concern with the problems in Europe right now. So we could definitely see 1260, but I don't think we're going to see much lower than that.
Hi, Larry. John again. Yeah, actually on that, as we're seeing some calming in Europe in the sovereign debt crisis there, and we're expecting some very strong numbers out of China today, even with the housing data in the U.S. Today being a lot weaker than expected, still, that means that the Fed is going to stick with their QE till the end and do whatever they have to do. So in some terms, that is quite positive for equities, don't you think?
I think it's very positive for equities, and my conviction is that if you look at the 10-year yield, we're going to see 3.25 to 3.5 the rest of the year. QE2 is going to go to completion. This recovery that we're in is so fragile, as you know, and we're also in uncharted territory. I don't think the Fed's going to do anything to upset the apple cart as of yet. That said, this is nothing but good news for the equity market, who's sitting on a pile of cash. Companies will begin to hire again. Productivity will continue to go higher, and we have a global expansion. So this is very good news for the equity markets. And I don't like to see red, but I'm glad that we had a little bit of a correction today.
Except, I mean, we've got cheap money out there. That's going some of it, and a lot of it's going into commodities, Larry. Do you see that as a risk for consumers, for companies, and therefore maybe a threat to the equity markets in the end, the way it feeds back?
Oh boy, you know, with the commodities market as a whole, I am definitely very bullish, especially on ones that are driven by scarcity rather than momentum. That's why I like platinum. That's why I like cattle and copper especially. But there comes a point when commodities get too high, it is going to affect the S&P and the broader stock market. For instance, like with oil, when oil becomes as a 9% of the global economy, we always see a crisis. We saw that in 1980. We saw that again in 2008. Right now, we're hovering around 7.5%. Oil prices right now are $92 a barrel. If oil goes up to about 120, will be at that 9% level, and that will be a crisis level for our economy. So it's kind of a funny way of looking at the stock market, but the S&P is full of commodities in a sense, and if oil does happen to get up to 120 sometime this year, I think I would start thinking about selling.